Well, ladies and gentlemen, I think we should start, maybe gain a bit of time so that we can have more time for questions. Well, this session is entitled The Oil Markets, and certainly it's something that I'm looking forward to, listening to the presenters. We first have Vincent Kaminsky, who is a professor at Rice University. I met Vince last year and I was very impressed with his presentation, and we carried on and he came over to London to speak at one of our events. So that certainly proves that he's a man really worth listening to, and I'm looking forward to his presentation on the marginal cost of oil production in the Bakken. And given what we said earlier, I think this is quite an apposite subject to look into again. So the floor is yours, Vincent.
Yeah, thank you, Leo. I would like to thank La Fondazione for the kind invitation to address this audience. I'll be talking about the marginal cost of oil production in the Bakken, or at least, how some forecasters and traders define it. I'm going to talk about production trends in the Bakken Formation, North Dakota part of it. I talk briefly about estimation of decline curves for a number of the North Dakota counties. This is the input to the calculation of the break-even cost of production at the wellhead. This is a concept, the concept of break-even production cost, which is widely used in forecasting prices and is widely used by the traders. And unfortunately, in most publications, this is given just as a number or a set of numbers. There is no information how it was derived or what were the assumptions. So this is a product of a black box. And my presentation is an effort to turn the black box into a gray box and give you some insights about how this number is calculated. And one of the conclusions is that in some cases you might prefer not to know. Chancellor Bismarck said that you may like sausage, but you don't want to see how sausages are made. And this may be true of calculations of the break-even production costs, because in many cases you have to go through a real detective work to get estimates of some inputs, and those inputs or those estimates may be highly unreliable because they come from a very noisy, chaotic systems. I teamed up on this project with a friend of mine, Józef Liskowski, who is working for the Energy Information Administration. He is one of the contributors to the report which is known as the Drilling Productivity Report, information about productivity of the oil drilling wells in the US. And I highly recommend that you visit the EIA website to get some information about it. And of course, the views we express here are ours and don't necessarily represent the positions of the EIA of Rice University. This is a slide which represents just-in-time delivery. I have inserted it into a presentation following the discussion after the first panel. It shows you the summary of the break-even costs at some producing regions in the United States. It comes from the report which was published a few days ago by the IHS Energy. Formerly this was CERA Associates, Cambridge Energy Research Associates. And they published a report regarding the potential lifting of ban on the U.S. oil exports. And this will be one of the topics of one of the presentations at this panel. So as you can see, the numbers are all over the place, and hopefully my presentation will explain why this is the case. So what is the motivation behind this presentation? I spent about 30 years supporting the traders in the financial markets and about 20 plus years supporting traders in the merchant energy business. And one of the questions which was asked very frequently by the traders was the question about the marginal cost of production of oil. And we would agree with the traders that commodities are typically priced at the margin unless we have regulation or rationing. But the problem is that marginal cost tends to be a very elusive concept. Before you can start estimating marginal cost, you have to answer a number of questions. Are we talking about small or discrete increments of output? Are we talking about private or social costs of production? What is the time horizon over which we want to estimate the marginal cost? Are we estimating the marginal cost of production under current or future conditions? In other words, are we talking about production increment from the existing capacity, or we are talking about incremental production capacity? Are we looking at accounting or economic costs? The problem is that in many cases accounting may distort rational economic decisions because the executives are judged and evaluated and rewarded based on the accounting results and not on the economic results. Another problem is that textbook definitions are not very useful. We don't operate in the world of continuous production and cost functions. It's very difficult to build 1/10 of a pipeline or drill half of a well. And in many cases, the definition of what is a marginal cost will depend on the definition of the boundaries of the system we are looking at. In this project, we are using data from North Dakota Industrial Commission, Department of Mineral Resources, Oil and Gas Division. I was looking at the database of roughly 450,000 records, which provides information about oil and natural gas production by well, with information about well type and drill type. I am also using well information available from the same source. I am using information from the U.S. Energy Information Administration and North Dakota Pipeline Authority. So first of all, what is the Bakken? You can see the Bakken the U.S. part of the Bakken producing region, which is located mostly in North Dakota and with a small part in Montana, but it extends into Alberta and Saskatchewan in Canada. And what is very important is that the Bakken is part of a much bigger basin known as the Williston Basin. And under the Bakken, there is another formation which is known as Three Forks. So some wells which are drilled in the Bakken area may go through the rock formations corresponding to the Bakken layer and go into Three Forks, which makes everything much more difficult. The Bakken is the area of about 200,000 square miles. It's one of the largest contiguous deposits of oil and natural gas in the United States. Oil was discovered in 1951. The rapid production growth happened after 2007, and it was made possible through rapid improvements of two technologies, horizontal drilling and hydraulic fracturing, combined with pad drilling. How does it work? So from one pad, production pad, one can drill a number of vertical wells. At some point, the direction of the drill is changed, and a vertical drill turns into a horizontal drill. And once the horizontal section of the well is drilled, it's fractured. The rock formation around it is fractured by injecting huge amounts of liquids under very high pressure and by pushing proppant. Proppant is a technical word for sand into the man-made fractures in order to prevent them from closing when the pressure is removed. One can drill a number of different wells from one pad, and the rigs are placed on rails. And after one well is drilled, the rigs may be moved a few yards away, and a new horizontal and a new vertical and horizontal well will be drilled. You know, the Bakken can be seen from the space, and the reason why it can be seen from the space is that there is not enough infrastructure to capture all natural gas produced along with oil, and it is flared. And this is the reason, you know, why we can see those flares from the space. The Bakken consists of three major members. Two members, the upper and lower, the upper member and the lower member are made of black organic rich shales. The middle member is composed of siltstones and sandstones. All those rock formations are characterized by very low permeability and low porosity, and this is why we have to use hydraulic fracturing in order to extract oil and natural gas from those rock formations. Another very important fact is that the shale rock formations are anisotropic, so this means that they have different qualities along different spatial directions. You may drill one well in one location and have very good results. You may drill another well half a mile away, and the well will have dismal results. And this word, anisotropic, should be written in flaming letters on the wall of every the executive in the natural gas and oil company, because it has profound implications for the economic results and future production volumes. The chances are that the engineers in this business, who are very clever, very creative, will identify first the sweet spots, and then they will move on to lower hanging fruits. And the problem is, you know, that they will be fighting Mother Nature all the time, you know, and they may succeed in the beginning, but at the end, Mother Nature will always win. As I have said, the rapid production of oil in the Bakken area started in 2007 when hydraulic fracturing and horizontal drilling were applied on a large scale. As you can see, North Dakota and the Bakken are true American success stories. You know, at this point, the production of oil in North Dakota is reaching 1 million barrels a day. So this is, you know, and this is practically, and in the case of the Bakken, is, you know, it's practically from from zero a few short years ago. The growth of production in the Bakken is associated with improvements in rig productivity. Improvements in rig productivity come from two primary sources. You know, first of all, it's an example of learning by doing. You know, the companies are becoming more and more effective in drilling vertical and horizontal sections of the well, and also they are finding new techniques, developing new techniques for drilling longer lateral sections of the well, and also they are better in fracking by isolating sections of the lateral part of the well and applying pressures over the short sections called stages, and it improves the outcome of the fracking process. There are some very interesting developments you can see on this slide. Around 2009, the number of rigs dropped, and this was related to the first to the drop in oil prices, but also to the financial crisis. The companies drilling in the Bakken are highly leveraged, so with credit crunch, it became more difficult to obtain funding for additional wells. But what happened at the same time is that the rig productivity increased. Why? The industry concentrated on the most on the best spots, the sweetest spots in the Bakken, and also they started using exclusively the most efficient modern rigs. Right now we can see continued improvement in rig productivity, and also we can see that the number of wells started dropping. It's very interesting is that that this drop in the number of rigs is associated with the increase in the number of rigs deployed by the 5 most efficient producers. So this is an indication that that the industry is going through the period of shake-up, and the most efficient, technologically advanced producers are winning. The Bakken wells are characterized by very steep declines. A production from an average well may drop by 65% a year, continued by a drop of 35% a year. And this has again profound implication practically for everything. The industry in the Bakken and in general in the shale locations is on a treadmill. So this means that you have to keep running faster and faster to stay in the same place. So if you look at the different vintages of well, you can see the impact of improving productivity. The initial production from the wells of each vintage is going up, but the decline patterns we observe in practice are more or less the same, or at least are similar. When it comes to moving oil out of the Bakken, we can rely on the pipelines. And there are 2 major routes out of the Bakken. One through Clear Brook in Minnesota, and oil can be taken to the Midwest refinery centers, or you can go south through Guernsey and Wyoming and take oil to the refineries in the Rockies and the Midwest. And also, you can use some of the oil locally in the Tesoro refinery, but this is just 7%. The constraints on the pipeline systems were a major factor, moving the producers to rely to an increasing extent on rail transport. Currently, 67% of oil produced in the Bakken region is transported to the refining centers by rail, and only 25% is transported by pipelines. And in the case of rail, oil is typically transported by the so-called unit trains containing more than 100 cars, which are sometimes 1 to 1.25 miles long. The fact that pipelines are used, the fact that railways are used to such an extent to transport oil out of the Bakken implies that the industry has to rely also on trucking of oil to the rail terminals. And currently 56% of oil in the Bakken is moved to the pipeline or oil terminals, to the pipeline or rail terminals using trucking. And this reflects the fact that the local gathering infrastructure is lagging behind production growth. So the first step in estimation of the break-even cost was estimation of the so-called decline curves. We used a specification which is known in the industry as a hyperbolic curve. This curve is used widely in modeling volumetric flows from a well. And we looked at production by the counties. This is not necessarily the best way to aggregate the information. Probably a better way to aggregate the data would be to aggregate the data by a producer or by a formation. But the problem I am facing is that I do all the coding. I don't engage in enslaving graduate students, so my progress is limited by my coding skills. And this is an example of a curve which corresponds to a hyperbolic specification. The data estimated for this report was for the well vintage of 2010, just to have enough data to go through the estimation process. The production data for each well was shifted artificially to January of 2010. and this is because we are looking at the production as a function of time since the moment of initial production, and we want to normalize the data. And now, unfortunately, it introduces the bias and estimation process. If you go well by well, you can see that in some cases you have fairly regular production, but you may see the well like this one, and this is what happens what happened probably in this case, that a well was drilled and tested, but there was no local infrastructure. For example, there was no tank battery built next to the well, so the production couldn't take off. In this case, we had a well which was tested, which produced, and then something happened. And it might have been something as simple as liquids, condensates, water, or natural gas liquids accumulating in the vertical section of the well. In such a case, the solution is very easy. You can just run the pump jack for an hour every day, and it's called priming the well, but it may be very expensive because you don't want a worker driving 50 miles one way to do this. So typically a bigger producer will sell the well to a local talent. You can call him Baba and Son, and they are, they have very low overhead, and they don't worry about, those costs. But the outcome of the combined outcome of all those problems is that production is artificially shifted towards the back of the curve, and you see smaller declines that you would really see in practice, and this is something you have to work with. I worked with a number of counties, starting with which represents the biggest production in 2010. We are talking about McKinsey, Mountrail, Williams, Divide, and Burke. I went through the estimation process for county by county. You can see examples of some results. They happen to be widely dispersed, and this is the outcome of the problems I've been talking before. The diversity of the shale rock formations, and also diversity of different producers with different skills and different technologies. And then those curves, the decline curves, estimated county by county, are used to estimate the break-even cost. Before I give you some information about the break-even cost, let me introduce some terms. In the US, the mineral rights belong to the landowners unless they sold them. And in order to acquire the right to drill on a landowner's land, one has to acquire a lease, and a lease has several components. A lease bonus is an upfront payment, typically in dollars per acre, and the lease payment may vary from a few $100s per acre to the levels as high as $10,000 to $14,000 per acre when a gold rush mentality develops in certain locations. And this is another reason why you may have such a wide diversity of costs. A lease is held by production, and it means that it ceases when production stops. Drilling a well is required to prevent the lease from expiration. If you don't drill a well within the first 3 years, typically the lease expires. And in some cases, it pushes the producers to start drilling, even if it's non-economic. And the final element of a lease is royalty payment, and this is part of the output that goes to the landowner. There are in different states you have different rules for calculating royalties. North Dakota, after a court case listed on this slide, moved to the so-called at the well doctrine, which means that certain costs which are incurred in processing oil are deducted from the value of the output for the purpose of paying or calculating royalties. So how do we calculate break-even price? It's the flat price that equalizes total discounted cash flow from the future production and the initial cost. And the initial cost is defined as the cost of drilling the well and the lease bonus. And I have to say that this is a very blunt tool because it ignores a number of costs, like, for example, the cost of fixing non- and underperforming wells, the cost of building and maintaining local infrastructure. We are talking only about the cost of the well. But we are not talking about the local gathering infrastructure that has to be developed in order to take a well to the refining centers. We are also ignoring the costs which are related to trucking oil to the railway terminals, terminal charges, shrinkage. And I have some estimates of those costs. Let me just say that my estimation, based on some assumptions, following the detective work I went through, I estimated the break-even price for Mountrail County at $72. You can compare it against the number IHS had for the Bakken for one specific location, which was within, I think, $2-3 of my number. You know, this is the slide which shows some of the estimated costs which have to be added on top of the break-even costs calculated at the wellhead. So we are talking about, give or take, you know, probably close to $10. And on so what we are ignoring in this calculation is the social cost. We are not talking about externalities. You know, a single well requires about 2,000 heavy truck trips and about 1,400 light truck trips. You know, and it causes a lot of damage to the roads, and the taxes which are paid and which are included in the break-even cost, and the taxes on gasoline and diesel probably don't cover the cost, the damage to the local costs. And this is not all of it. Oil has to be taken from the Bakken to the refining centers. I have some estimates of the rail cost, and then we are getting to the point where we can start competing with the internationally traded crude. And the problem is that, you know, that the U.S. Gulf Coast is effectively turning into a point where we have currently congestion, which may be relieved if we have the ban on oil exports lifted. And this is the topic of the next presentation. Thank you very much.
Thank you, Vincent. It was a very interesting presentation, and finally we got to some a number, and it's not the number 7, is it?
You know what the inputs are.
Yes, true. So we go on to the next speaker, who is Robert Levin, Managing Director of Energy Research and Product Development at the CME Group. Robert will look at the issues in the practice of using reference prices, which is an old topic in the oil business, almost back to the beginning, because there's so many varieties of crude. I think reference prices hold some of the keys to the mysteries of oil. Robert.
Thank you, Leo. Thank you to the FEEM for inviting me again to be here. Really, just to hear all the other presenters and some of the conversations going on, they're very impressive. In fact, I think you've already seen some evidence that some of the participants here are able to operate very complex and have mastery in complex and complicated equipment. You also see that some of the presenters are able to take complicated subjects and make them look easy, which is what I think Vince just did. And my challenge is a little bit less, because I'm going to try to take something that's kind of a simple concept and keep it at a simple level. But if I make it look complicated, then I'll duck as you throw things at me. I hope I don't do that. What I'm going to talk about is principally a continuation of some stuff I've been done, and I am not really, I mean, I'm a product developer and do a lot of other stuff and cover, have to cover a lot more than just oil. But in terms of some research and contributing to it, there have been some ongoing issues, as Leo mentioned, and part of this is building on an article that was in Bassam's Oxford Energy Forum earlier in January. And in that, what I did, and I'll go over some of that, but that's not really what I'm here to talk about today, but it kind of builds from that. Focused on WTI and Brent, and mostly dated Brent. In fact, mostly Platts dated Brent in that. And the reason, amongst that family, and there's a lot of different versions of Brent, and most people really don't understand the distinctions in how they, I have found, how they really operate, and I'm not going to go into all those details, but if somebody insists, we can do that. Platts, in particular, is very important in terms of what we call the partials or contract for differences, the CFDs. But why they're really important is that what comes out of their market is used to price a lot of oil in the world. Certainly, a lot of the actual physical oil in the BFOE market. Secondly, a lot of production of oil at national levels where parties are using Brent as a reference. And then depending on what you believe about the relationship between dated Brent and Dubai and Platts Dubai, you may actually think, some people think that it governs Dubai. I'm not really going to get in that. There are different views on that, which would be even more oil because there's a lot of oil pricing internationally that is dependent on Dubai oil as well. Some of the differences, and I put a question mark here in the third bullet, that WTI is favored. You saw some of what I'm referring to with a trove of official and highly reliable public U.S. government data, mainly from the EIA. There's no question. The quality, the quantity, the timeliness of fundamental oil market information coming from EIA about the U.S. market, particularly a lot of it being relevant to what goes on with WTI as a benchmark, it's unparalleled. There just isn't anything like it elsewhere in the world, and that's certainly beneficial. The Brent, on the other hand, really has limited public fundamental information available. And what is prominent there, which is from the International Energy Agency, is actually released with a 2 to 3 month delay. And the reason I say 2 to 3 is that after it's initially released, there are 2 subsequent revisions a month later and a month after that. And that's when they have their finalized data. And sometimes those revisions are very substantive. And this is through no fault of the IEA. They would love to have access to more data and more quickly, but they don't. What I'm really going to do in the end is I'm just, after we talk a little bit about the fundamentals, is just do some analysis, just some straightforward regressions on responsiveness to some fundamental market information. Briefly, just kind of reprising from the Oxford article, the Energy Forum article, WTI is part of a very active, has a very active forward market. That forward market in the U.S., including the Mid-Continent and the U.S. Gulf, is many more streams than simply WTI. So there's great substitutability, and that happens in that market. The futures market itself is actually, the terminating obligation is a delivery obligation. So those deliveries are nothing but subsets, really, of the cash market or the physical market. So you have real absolute convergence there. There's really not much dispute about that. And to the extent that all those markets interact, then you have a very strong relationship with the cash market. In terms of what does the EIA produce in terms of important data on a weekly basis, inventories, nationally, regionally, locally, that's within the actual delivery area for the WTI pricing point. They give imports and exports as well on a weekly basis. They give refinery utilization. That's a lot of very important information. I may have made a mistake here. I know the inventories are within 3 business days, which in the oil market is virtually real time for that kind of data. Compare that to several months. I don't remember. It could be a little bit longer than that for some of the other data, and it might be the same. I didn't check that, and I apologize for that. It also provides with a 2-month lag some interesting monthly information, one which I'm going to use today, but this international production interruption, that starts in 2011, movements of oil between some of the regions, and much other stuff. The underlying physical market has thousands of regular customers, hundreds of active, and delivery is uncomplicated. I mean, I say hundreds. I've been told by the operators there, you could deliver 1 barrel if you want, okay? Very different than cargo markets. Cargoes are hundreds of thousands of barrels at a time. And even now, they may, in fact, most of the cargoes, they might be 500,000 or 600,000 barrels, and they're part of vessels that have in the millions of barrels. So there are multiple cargoes on those vessels that are all packaged. Now, it's not to say that all the trading of WTI or those U.S. oils are in 1 barrel allotments or even 1,000 barrel allotments. It's simply that it has that kind of flexibility, which is very valuable. The question mark I had on the data trove, and this isn't always a negative thing, but one thing, because there's so much good data and information for WTI has clearly been subjected over the years to a lot of sweeping theories. And Brent probably hasn't. In fact, there's been a lot of assumptions about Brent that it must be in order, but nobody really knows because they don't have the data to evaluate it by. Meanwhile, in WTI, you have all these data I was just referring to. Now, from the Oxford article on Brent, very limited public information. I'm not actually sure if even some of this really strong fundamental information on a timely basis is even available in non-public form. And what I'm talking about here are the things like the inventories, the refinery utilization, the imports, exports in different areas, not commercial transaction data. That is talked about a lot, and some of it's reported, some of it isn't, but it's certainly is discussed in the Brent market is more than perhaps in any other market, and sometimes people are probably well informed, and sometimes they're probably not so well informed about that. There is some of the data that is valuable though for Brent that is public, which is just provided by the commercials, is their loading programs for the coming month. They do that in advance. That's extremely helpful information. And of course, ICE's Brent futures are very valuable, and that's public. I mean, nothing could be more public than futures prices. The Platts dated is used to price many physical barrels. One thing to keep in mind, the way it's structured, and I want to focus on a lot, but this was part of where the article I was writing was, okay, you don't have this fundamental information available for Brent. So how do you measure whether it's responsive to fundamentals? Then secondly, if you actually look at the mechanisms, so what's the connection here? And if you look at the sort of stated assertively here, but I'm glad to go into that detail, the Platts dated mechanism is really two different cash-settled mechanisms that they come up with kind of prices for each day. They put them together, and what they come up with from that is sort of a forward price for the Brent market and also the dated Brent price, which is used as the base for a lot of other pricing. But it isn't at all tethered strongly to the physical market. Now, Platts would tell you, and I believe this is true, that if it turns out under some unusual, some occasional circumstances, because of the rules, if two parties are matched in their market 6 times and they're equal and they're on opposite sides, then they have a forward market obligation. That's according to Platts rules. No reporting on how often that happens. I'm sure it does happen, but I think it is the more of an exception than the rule. And certainly when people are in their market, they don't know that's going to happen. So they're not advancing as though or using this market necessarily as thinking that, oh, I'm going to have a forward market obligation based on this. Nonetheless, this is used for a lot of pricing. And sort of the bottom line here is if it's really not tethered so much to the physical market and really have a strong kind of relationship with the other mechanisms, it's a very important mechanism, and I'm not criticizing it. And that's the other thing I want to say. This isn't critical. It's really more descriptive, but it's kind of absent from a lot of people's understanding. It's a negotiation for them because they're determining the price that will be the chief reference for all this physical oil that's referencing Brent. So that's an important price, and that's what's going on in that Platts market. But the idea that, oh, well, there's this something going on in a physical market here and there that has to impact that, I think somebody's going to have to demonstrate where and how and why exactly that must be the case. Certainly it's conceivable that the other BFOE mechanisms are responding to Platts and dated and following their lead in price discovery. All this is kind of interesting, but it's not really what I want to get to and talk about more today. It's just kind of the background. Sort of statistically, I just want to kind of evaluate how responsive these benchmarks have been to reported fundamentals. Here I'm just testing, and this is generally when I do these things, this is what I do. I actually look for some basic microeconomic principle and see, hey, is it operating or not? Does the forward price curve respond to changes in market fundamentals? And if so, how? Now I'm going to be looking here, and I've defined it as the backwardation, which maybe I should have defined it as contango, but what I did was I had the first month minus the second, so I turned it into backwardation just to have positive numbers, sort of correspond to backwardation. I've looked at, in terms of, I've done this for weekly data and for monthly data. I think the weekly data has a certain amount of importance because I was talking about how it could even be real time. I did look at the inventories both in the regions that we call them, I say pads 2, in Cushing and actually, I said pad 2, here's actually pad 3, I apologize. The US Gulf Coast inventories, and also looked at some exports and imports that are reported on a weekly basis, I tried to test that out, and I was also interested in looking at three things: WTI, how it responded to this, how Brent responded to it, and then just for some additional comparison, I also looked at how WTI minus the Brent price in the front months responded to this. Now the monthly results, and I've done this previously too, by the way, and that last page referenced some of that, and it was on a conference several years ago. And at that time, just to make it clear, WTI had been much more responsive than Brent. It was a very tumultuous time in the market. There was a lot of excess inventories in the market. It was really in the 2009 to early 2010 time frame that I looked at. And there was no question that WTI, and it has generally been very responsive, and it won't be too surprising that it is here. And actually, in the first panel, you saw Professor Elder's, his results a little bit different because how he was looking at it, but he was talking about responsiveness to very important fundamental information, but in a time period that precedes what I'm looking at. For monthly, I took from January 2011 to March 2014. I did this because that's when EIA, among other things, had a very interesting data stream that refers to outages from international oil production. And why do they have it? My guess is because when the Libyan upheaval began, that was in January 2011. I don't think it's a coincidence, so I just took what they had. I looked at, in this case, I looked at OECD stocks. And by the way, their stocks are reported, the ones I looked at, in days supply. And I looked at it in two forms. I looked at it, but it didn't turn out to be very significant, so it doesn't really matter here. I looked at movements in regions between the Midwest and the U.S. Gulf in the U.S., as I say, the Midwest and the Gulf Coast in the U.S. The results are really the following. And the Brent, the backwardation was not very responsive, and no variables came up significant. WTI, the backwardation was quite responsive. Unplanned reductions, the confidence level there was above 99%. Oh, by the way, this is me, and some of you may object. If it's above 90, I'm taking that as being significant. You don't get and this sort of thing, you don't get a lot of things that are hanging out around 99%. There's a lot going on there. And in some instances, I would even report to you when it's in the kind of the 80s because, well, there's reasons you'll see why. The R squared was kind of snug. I mean, given 39 observations and what we're looking at, it was almost 63 there. Interestingly, the movements from the Midwest to the USGC had a negative coefficient, and the movements from the USGC back to the Midwest were positive. They're very consistent with each other. One might wonder, are those movements responding to the backwardation? But that's kind of why we're testing this. But I fully recognize the causality in both directions, and I wasn't really trying to untangle that because I'm really just trying to get a sense of responsiveness in general. WTI minus Brent, it was the only significant variable here were movements from the U.S. Gulf Coast to the Midwest. Now, just kind of thinking through this, why are we looking at these variables? And well, for one reason, they're collected. So you do have to base your analysis on what is collected. And these are monthly variables that are collected here. And I didn't use inventories for the U.S., which also are at the end of the month, which might have improved these results. But it's, monthly data is something that, given that the oil market does, I think, respond to things more quickly, and we do have weekly, I didn't really know what my expectations are, but I have the opportunity to look at this, and I did it. And to some extent, it's pro forma on my part, but I wouldn't want to not share it, and especially since the EIA now has that very interesting data stream on interruptions to production, which turned out to be significant, not surprisingly, but that's a very interesting data series to be providing. And so I was very interested in seeing what those results would be. Now, going to the weekly results, I'm going to start with WTI and WTI minus Brent. First, there are a lot of similarities in these. Now, the data, I didn't cherry pick this, but if someone wants to, I did not look at anything beyond a recent 6-month period. I just chose it. I knew it kind of coincided, and you've been hearing about it today, some rather important developments that have been going on in the marketplace. Now, the U.S. production has been on the increase since even prior to 2007. You've heard a lot about it. You're going to hear more about it. It's well worth hearing about. In fact, that's one of the reasons I'm here. I want to hear what these other people have to say about that. However, the ability to move it outside of the mid-continent or where it's produced has only recently emerged. And you now have excess pipeline capacity from the U.S. mid-continent, where Cushing is, to the U.S. Gulf. You didn't have that. You didn't even have that when I started this analysis. That's really in Q1 this year. There's a couple of major pipelines. The Seaway's been reversed, and it's going to double its capacity fairly soon to 800,000. But the Market Link, which is TransCanada's southern link of the Keystone, which has certain notoriety because it's become a political issue in the U.S., the northern part of that, but TransCanada decided, why don't we complete the southern part of that called Market Link that also goes to the U.S. Gulf. Right now it has a little bit under, I think, 500,000 barrels a day of capacity, and that's going to go up to about 800 as well before the end of this year. Going through now the results, and there were 30 observations here. Once again, the independent variables are inventories in Cushing and at the U.S. Gulf. Imports from the U.S. in terms of crude and imports of crude at the U.S. Gulf, U.S. product exports and net petroleum imports. And WTI was quite responsive, and the R square was in the 0.7 and even higher range. In this case, different combinations happened to come out, and so more work would have to be done to determine which is the best combination. I mean, you have a little bit of crowding out of some of these variables at times, but not always in all of these, and that's kind of interesting as I'll get into it. But the strongest combination was Cushing stocks, U.S. petroleum exports, not the net imports. I looked at that, but the actual petroleum product exports and the U.S. Gulf Coast stocks. But at times the confidence level, depending on what it was combined with, was 84%. But however, it was significant when it was combined with other things, and you drop something else. So that's why I kind of include that in there on the U.S. Gulf stocks. Interestingly, the coefficients for both Cushing and U.S. Gulf stocks are negative. For Cushing, I expect that. I wasn't sure if that's what I expect for the U.S. Gulf. By the way, the coefficient is much bigger for Cushing, probably on like a 9-to-2 ratio. The net imports are negative, and the petroleum exports are positive. So those are consistent with each other. For WTI minus Brent, I actually got a snugger fit, which is sort of funny. And the same significant variables, same qualifications, same signs on the coefficients. Now for Brent, where I'd struck out when I did this in 2010, things changed, and I thought that was interesting. And I do think that's very interesting, and well worth delving into more. Ultimately, the snugness of fit isn't as strong. You're dealing with probably when everything is significant, around 0.35, but nonetheless, all the variables were significant. I mean, whereas I had some crowding out when I was looking at the WTI price, with Brent, they all managed to give room for each other to be significant. And that's in terms of Cushing stocks, U.S. Gulf stocks, both negative here. Net imports was positive. Product exports, which is the opposite of net imports, would be negative. It was sort of interesting. In fact, the lowest confidence level was actually for the Cushing stocks. The coefficients here between U.S. Gulf and Cushing were the same for the most part. They were, which I thought was interesting. So they were about equal with each other. So parting reflections on this. Not surprising, as I said, that WTI reflects the fundamentals. It always has. You saw, I think, from the first session today, you saw another demonstration of that, of a period earlier in time to this. And even under very tumultuous periods, it has demonstrated that. Brent in particular, which is what I looked at, but in 2009, the first quarter, the world was overflowing with inventories everywhere. Now, it took a while for the OECD numbers to come out, and Brent was in backwardation for a good part of the first quarter then, which is sort of an unusual response to excess inventories, okay? Has something changed? Well, maybe, and maybe yes, maybe not. And what maybe has not changed, I think perhaps, and we're getting more into opinion, that previously Brent, when it was tied much more closely to WTI, piggybacked WTI's responsiveness to fundamentals. It's always had it, and people would arbitrage between North Sea oils and oils priced off North Sea and the U.S. and Gulf Coast. And they'll do that today, and they always have to the extent they can. But as people have noticed, there was some clogging in the U.S. system, so they couldn't really perform that arbitrage, or I should say that arbitrage was very complicated. Some people knew how to perform it, but it was much, much more complicated. And during that period, what was Brent doing? Maybe it didn't have its the fundamental information from TI, and it's still a very important price reference, extremely important, and still one on its way. What maybe has changed, though, is that those clogs, they're definitely gone now. And the last 6 months have been a period of time that overlap with that. And the incremental supply by the U.S., which nobody actually said, when you take less, when you minus imports, it's no longer that are no longer taking place, and then you take product exports to the world market, you're talking on the order of about 4 million barrels a day, which is quite material in world fundamentals. So it seems to me that it's very likely that I'm kind of expecting Brent is going to be much more responsive, and I think those Gulf Coast numbers in particular are going to be very, very important to Brent as time goes on. Thank you very much.
Thank you, Robert, for this very interesting presentation. I'm glad you came in on time. I didn't have to even lift the 0 minutes left card. Now we move on swiftly to Charles Mason. I give him the floor, who's going to talk to us about the tight oil revolution and its implications for exporting crude oil from the US, which is a very topical subject. I believe as we speak that the debate is ongoing in the United States, and there are the two big factions arguing about it. So I await your presentation with great interest, Charles.
Thanks, Leo. Well, I'd like to start by thanking Professor Minara and the Fondazione for the invitation. It's always a delight to be able to come back to Italy. And I'd like to thank Vincent for such a fabulous setup. He put up at least half a dozen slides that set things in motion for what I'm about to say, and in a certain sense greased the skids, not least of which he had one slide that showed pipeline exports that ran from the Bakken. One of them goes through Wyoming, and though I wasn't paid to say this, I would be loath if I didn't say that that pipeline is owned by the True family, benefactors of my chair. Let me start off here by giving you a little bit of a historical background. I'm going to go off script from the slide for just a minute, because a lot of things have sort of been thrown out the audience may be unfamiliar with. Let me take maybe 1 minute or so to give you a little historical background. After the OPEC embargo in 1973, in the US, there was a period of time when there were habitually very long lines at gasoline petrol stations, the response of which was that the US Congress enacted two pieces of legislation that fundamentally made it illegal to export crude oil, not crude oil products, not gasoline and so forth, but crude oil itself. And that particular ban has been in place since, for 40 years or so. It was moot. It didn't matter that we had a ban on exporting crude oil because we were huge net importers. This all changed in the middle of this slide here. You kind of see. So there's several things that are going on. The dashed lines are showing you, I'm not speaking into the microphone, apologies. The dashed lines are showing you production from tight oil deposits, so Bakken, Eagle Ford. These are important tight oil deposits within the U.S. Permian Basin is the western part of Texas. There's also some important stuff there. The dot dashed line in yellow is stuff from Canada, principally from the Albertan oil sands. And this is all meant to be relative to things that were happening in 2007, so it's showing you the increases in production. All of these things combine, and you can see and others have sort of hinted at this, you can see starting in 2011, there's a big run-up in production that's coming into the heartland of the United States. Big increases in production. All of this has to go someplace. And it winds up at the trading hub in Cushing, Oklahoma, and this particular glut has been largely ascribed to generating a big discount in the price of crude oil sold in the U.S., West Texas Intermediate, in comparison to the Brent price. And that's all fine, but one of the themes that I want to play up in this presentation that Bassam set me up for was that these aren't all sort of the same thing. It's not apples to apples we're talking about. There are differences in quality that need to be taken into account, and I'm going to spend some time talking about that. So here's an illustration. This is just to kind of give you a flavor of how things are different. This is a slide that I harvested from a presentation that came about at a conference, a little mini conference that was put on by the Brookings Institution a little over a month ago. Brookings Institution is an important think tank in Washington, D.C. They had asked me to come and give something like a precursor to this talk. And amongst the participants were a couple of individuals from oil companies. This is from ConocoPhillips, a big oil company. And they're showing you the kind of the quality differences between different important metrics of crude oil. And the ones I really want you to focus on To the far left, Eagle Ford is a kind of a conventional, typical, canonical shale oil, tight oil production. Mars is kind of a conventional, the typical oil that's coming into the U.S. that's being processed by U.S. refineries. And I like this slide because it color codes things that are different. You'll note here, particularly these middle things are much smaller in the new tight oil deposits, and these very light things like naphtha are much larger. In liquid petroleum gas, natural gas liquids starting to show up. These are things that you don't see in conventional, older, more traditional deliveries to U.S. refineries. So there's something fundamentally different that's going on. In conjunction with that last piece of evidence, here's a slide that gives you a flavor for how things have evolved historically. These are meant to be sort of suggestive as opposed to deeply analytic, as most of my slides will be today. The average, so the measure of how heavy or light is what's known as API gravity, and that was the number that was sort of hiding in the back of the last slide. The blue solid line that's sort of making its way down from 1985 down through 2005, you can see this general slow downward trend. This is an indication that U.S. refineries have evolved over the course of 20-odd years towards accommodating slightly heavier crude oil. They've designed the refineries to process this. And we'll talk a little bit about why that is and how that matters and so on. Starting about 2010, that all changes. And what's really striking in this slide is that the average imports of crude oil into the U.S. now become much, much heavier. At the same time, this red dashed line, this is showing you kind of the average delivery to U.S. refineries. You see that up until about 2010, it tracks very well to the imported crude, and this is because most crude oil that's being processed at U.S. refineries is imported. And it's been much the same since 2010. So the refineries haven't changed the kinds of crude oil that they process. The imported crude oil has become much heavier. How can that be? It's because U.S. production, which is now much larger and has been over the course of the last 4 years, is vastly lighter than is imported crude. Right? So there are these two types of crude, if you like. This is really a story about two types of inputs: light crude oil, heavy crude oil. It's more sophisticated than that, but if you just think about it in that terms, two types of inputs, light and heavy crude oil, you'll get a long way towards seeing what's going on. Why should we care about the type of crude oil that's being brought in? Well, the way that refineries work is that they take these, if you want, you can think of a barrel of crude oil as containing a bazillion molecules, or a bazillion chains of molecules. It's not homogeneous. Each barrel has some crude oil that's quite heavy, which means it has a molecular structure that has lots of carbon molecules, and some crude oil that's rather light, fewer carbon molecules. Because these things differ in weight, they get processed differently. Every refinery starts off with what's called a distillation unit. They basically boil the stuff. Molecules that are lighter rise faster. And so that'll be light products like jet fuel and gasoline. Heavier stuff takes more temperature and is harder to process from this distillation unit. So in response to this, over the course of time, U.S. refineries have adapted in a particular way that I'll talk about in a moment. The feature of this simple schematic would suggest that lighter crude oil is easier to process, at least in this sense, and therefore should be more valuable. Okay, so if you imagine a latent price, if I have two things, light crude oil, heavy crude oil, all else equal, the light crude oil should be worth more. The other thing that's important in this is that not all crude oil is created equal in terms of its sulfur content. Refineries can't use sulfur in it. You can't put it in gasoline, so that has to be removed. So sulfur is a bad thing. More sulfur means lower price. Robert talked a little bit about, I mentioned these two geographic regions in the U.S., PAD 2 and PAD 3. That's just an acronym that the U.S. Energy Information Administration uses to refer to different parts of the country. PAD 2 fundamentally means the Midwest, which contains the Bakken play. most of it anyway. Pad 3 means the Gulf Coast area, which contains most of the U.S. refiners. The graph to the left shows you the average API gravity, acronym notwithstanding for SG. Don't worry about what SG stands for. And you can see that it's much higher than stuff that's being kind of processed by refineries on the Gulf Coast area. That's the red solid line. Okay, so that would seem to suggest that Midwestern crude oil that's delivered to refineries in the Midwestern part of the U.S. ought to be worth more. The graph on the right shows you sulfur content, and you can see that the blue line, which is, again, the Gulf Coast receipts, tends to be higher in sulfur, should be worth less. These two pieces of information are suggesting that Midwestern crude should price higher than Gulf Coast crude. All else equal, simply on the basis of their latent content. Okay, and this slide hints at all these things. Now, there are workarounds. Bassam suggested that when Libyan crude went offline, there was no way to immediately substitute for it. True, but refineries can take different types of slates, crude slates. They can use different constituent ingredients. They won't be able to produce at quite the level of efficiency. There's a bit of a trade-off. And there's a trade-off at U.S. refineries, too, because they've been designed to handle heavier crude. They would prefer to get that, but if they can't get that, they still can handle lighter crude. It doesn't work quite as well for them. And that would suggest that they require something of a discount in order to process it. And that's a theme that I'm going to play up here in a minute. In the same way, I suspect that European refineries required something of a discount to handle heavier crude when it was used to supplant Libyan crude. Okay, so how do you deal with heavy crude? You put in place what's called cracking capacity. An indication that cracking capacity is very important is contained in the graph on the left, which is a little too busy given the time constraints. So just look at the one on the right. Those are the refineries in the Midwestern U.S. That's the blue line with dots. And in the Gulf Coast area, that's the red solid line. On the y-axis is the fraction of capital of refining capacity that's allocated to cracking. Cracking just means you break the chains in parts. So if you've got a really long chain, it's too hard to process, you break it into two smaller chains. And you can see that Gulf Coast refineries have heavy reliance on cracking capacity. Something in the neighborhood of 65% of their capacity, of their capital is dedicated to cracking. And this is increasing over time in the Midwest in large measure because of this steady increase in production coming into the U.S. from the Canadian tar sands. Oh, sorry, I was told by my friends in Alberta it's oil sands. Tar sands is pejorative. Okay, so I have here the makings of a hedonic regression. I have data on refinery acquisition costs at different places in the U.S. I have information on the constituent components. The crude oil comes with a certain API gravity and a certain sulfur content. This information is available on a monthly basis for almost 10 years by the Petroleum Administration Defense District, DPAD. So we have something like 600 observations. And there was all this evidence that you've seen up to this point that suggests that there was something like a sea change that took place in 2010. So I'm going to say ex ante, it seems like there might be something different after 2010. And possibly that something that's different after 2010 is coming about because of important increases in production from tight oil deposits that's being fed into Midwestern refineries. So on this particular point, I'll make one slight sort of tangential remark. The Bakken field is unfortunately located, for historically accidental reasons, it straddles two districts. Montana, which is the sort of the western part of the Bakken play, is in Pad 4, as is Wyoming. Everything else is in Pad 2. So the stuff in Wyoming and Colorado and Montana, which is sort of a minor player in the grand scheme of things, is more like Pad 2 than is anything else. Everybody else is on a coast somewhere, and they're more alike than they are like the two interior sources. So you might expect that there are differences before and after 2010, and you might expect there are differences between the two interior regions and the Gulf Coast regions. And here's, as they say, the proof in the pudding. I have here for you two hedonic regressions that include, amongst other key ingredients, sulfur and API gravity. And in this way, I'm going to be able to get a feel for the latent value of a small reduction in sulfur or a small increase in API gravity. There's a dummy variable to pick up observations for Pad 2. There's a dummy variable to pick up observations for receipts to refineries in Pad 4, of which there are not many. And then those things interacted with dummy variables for after 2010. The whole laundry list is in the regression on the left. They're mostly significant, but for the interaction between the post-2010 and Pad 2 dummy variables. So the one on the right drops that out for illustrative purposes. And you can sort of see here the key takeaway messages. A 1% increase in sulfur costs you about $3 a barrel. A 1 degree increase in API gravity is worth about 65 cents a barrel. So if you have oil that is higher in API gravity and lower in sulfur, it ought to be priced more, as this would seem to suggest. Right? Pad 2 refineries get lighter, sweeter crude than Pad 3 refineries. That suggests that they ought to be paying more for the crude oil that they receive, but they don't. In particular, in the last few years, they've been receiving a steady discount. And even before that, they should have been paying more, and they were paying the same. So all these things together tell us that they are getting kind of an ongoing discount. They're getting this ongoing discount. It's on the order of $6 and change, $6.50 a barrel. They're getting this ongoing discount, thanks, in large measure because of the phenomenon that I talked about a moment ago. They're geared to take heavier crude, even though this crude oil would be worth more if it were sent to the proper refinery. It isn't. It's being sent to refineries in the Midwest and up until quite recently only to refineries, mostly to refineries in the Midwest, now to a certain degree refineries in the Gulf Coast area, and there it sits. Refineries in Europe perhaps would value this crude oil more, but we cannot send it there because of historical accident. Exporting crude oil is illegal. So again, here I'm going to stop for a timely anecdotal comment. Just within the last 2 days, a major producer in the Bakken field has put in a request to the U.S. government for an export license. This was just within the last 36 hours or so. So the timing was just spectacular for this talk. I didn't bribe them or anything. I mean, certainly I don't get paid enough to bribe them. But we've had this particular phenomenon in place. We have a glut of crude oil that's sitting in the Midwestern U.S. We can't send it overseas. Part of the problem associated particularly, I think, in this part of the diagram, but not so much towards the very end, comes about because of pipeline delivery constraints. Right? So this is a sort of an important asterisk to what I'm pitching in this story, that there are these delivery constraints. Historically, we would be importing crude oil into the Gulf Coast area. Anybody in the Midwest that wanted to refine crude oil would be receiving it from the Gulf Coast, so the pipelines were shipping oil north from the Gulf Coast into the heartland. With this big influx in deliveries that's coming about, in particular because of the Bakken, but also because of the deliveries out of West Texas, now there's a desire to send oil in the other direction. This isn't like flipping a switch. Reversing the flow in a pipeline is a very difficult and costly thing to do. There are contracts that have to be honored. If you just imagine you're standing in a you're standing out in a stream and you put your hands up and say, stop, go back. That's sort of the thing that we have to imagine. So this takes a considerable amount of planning. The reversal that Robert talked about is the result of that planning, and it was the better part of a year in the making. Once that pipeline flow was reversed, then it made sense to expand the capacity of that pipeline. So the owner of the pipeline then proceeded to expand the capacity to a substantial amount. And the combination of those two things, I think, is kind of what's being picked up here, right? And a point that I want to drive at is that despite this particular one-off event, this was a short-lived phenomenon. This sort of, if you like, rationalizing of prices came and went. And here's an indication of why and how. So I've got here for you 3 time series. We've talked a lot about West Texas Intermediate. We've talked a lot about Brent. Nobody has mentioned Louisiana Light Sweet Crude. So I'm going to mention it. Louisiana Light Sweet Crude is closer, at least in some sense, to Brent crude oil because it sits on the Gulf Coast. It doesn't have to be transported inland. It isn't subject to the glut that sort of accrued around Cushing. And you see that for the longest time, right up until we sort of had problems associated with this glut and Cushing, all three of these prices much more or less move the same. Then for a period of time, West Texas Intermediate sags relative to the others, and Louisiana Light Sweet Crude and Brent track each other very well. And this persists for a while until this pipeline reversal and expansion happen, at which point West Texas Intermediate is pulled up to the other measures, the other kind of global prices. And in particular, I think what has happened here is that there's been arbitrage that has rationalized the price difference between West Texas Intermediate and Louisiana Light Sweet Crude. And that kind of ran its course, and we now have sort of the reemergence of this glut. Now it's not at Cushing, it's just in the U.S., and this is what you're seeing just in the last few months, when the American prices start to fall below European prices. Right? So there's a couple of hints here. I think there's a couple of things that are going on that suggest what life might look like were the crude oil ban to be lifted. Number one, it would allow for a rationalization, international rationalization or arbitrage of prices. So now let me talk I got like 2 minutes, I think. Let me spend a little bit of time piggybacking on this unit train, this rail shipment idea here. Over the course of time, because of this increase in production, because of limited pipeline delivery infrastructure, particularly in the Bakken area, there's been this requisite increase in shipping oil by railroad. And this has led to, among other things, a displacement of other kinds of rail shipments, an increase in the usage of old, and I mean here by old 20-year-old oil cars, and a bigger volume of throughputs for railroads in the U.S. generally, on the same quality of track, on the same institutional infrastructure arrangements. This is like having more cars on the motorway. You're going to have more accidents. Right? And you can kind of see this. The number of accidents is illustrated here by the red line, and it's shot up in the last few years. On top of that, the rail cars that are carrying crude oil are carrying, the first or second slide, I think, showed that there tended to be a greater prevalence of natural gas liquids and other like kinds of things. They're more volatile. So if they derail and the car is breached, they're more likely to blow up, which is what happened in Quebec last summer. Right. At the same time that this is going on, there are these decline curve phenomena that Vince was talking about that are important phenomena. They mean that if you're in the pipeline business, you need to have a steady throughput. You know that any individual oil well is going to have a rapid fall off in production. All things considered, that means that it's going to be harder to motivate people to build pipelines. Pass this or remove the crude oil ban, and I suspect a lot of that disincentive goes away. Okay, so I'll just sort of leave you with this slide, and you can read the bullet points. I've been chased off the stage, and we'll go talk about this more if you like it in the discussion section.
Thank you, Charles. Now I think I know roughly what might happen if the ban is lifted, but I'm not quite sure because you said the price might go up, might go down.
You remember when you asked me what was going to happen to the price of crude oil, and I said, I'm not going to tell you for next year, but I'll tell you in a couple of years?
That's the same answer.
That's the answer.
Okay, thank you. So finally we go to our last speaker, someone I go back with many years, with Mike Davis, who is going to, he's from ICE Futures, he's the Director of Market Development, and he will talk about oil price benchmarks, another speaker today, to show you how important the subject is. I hope, Mike, you can enlighten us on the latest developments on this point. Thank you.
Thanks, Lee. I'll do my best. And thanks, first of all, to the Fondazione and to Matteo for the opportunity to speak today. I'm very grateful for the chance. So I've been reminded I need to speak right up to the microphone. As Leah said, I will touch upon the drivers of price in price benchmarks. I'm going to try and give you some, I see slight correctives to some of the ways that these discussions begin. And I think particularly for some of the academic papers we come across, I'm often struck by the initial assumptions that are made before the reams of fantastic statistical analysis begins. So I think I'm going to draw a little bit from some very valuable points that Charles brought up, and I was delighted to hear about analysis of crude oil in terms of its yield in refined products. Because time and again, we hear people talking about crude oil as if the price is formed in a vacuum. Crude oil is almost useless other than for what you can produce from it. And the key point about pricing, wherever it takes place, in whichever crude, is that it's formed in relation to the products that come out of it. And I'm going to build a little bit on what Charles has said, but he's also given the opportunity somewhat to skim over parts of this. I've got a lot of slides here. They'll be available afterwards, so I'm going to cherry pick a little bit. As it's the end of the day, I hope you'll indulge me in not spending any longer than I need to while you're probably tired and you've been very responsive all day. There are, as has been touched on, some tremendous changes going on in the world. One of the important points we sometimes don't realize in Europe in the debate is that Europe has a central role in global oil price discovery now between the US and Asia. ICE is the host to the ICE Brent part of the Brent composite benchmark, if you like, and the ICE gas oil contract is the world's largest refined product future as well. So we actually host the two biggest global benchmarks in futures terms. So don't expect anyone in the US to say, well done Europe, you're the number one. Just bear that in mind. So in terms of the discussions that go on externally around policy making and regulation, bear that in mind. I think no one is in favor of bad practices, but it's important to look at the drivers for price regulation and for price discovery in terms that they are. And we certainly are keen to engage with policymakers going forward to try and help to educate them. And I hope that they get a chance to see some of the presentations that we've had today at some point. I'm going to start out with asking you some questions. Rather than you just listen to me, I'm going to throw a few things out for you. And I want to just test what you think about some of these phrases. And you may have come across some of them in papers. You may have heard them in the press. And I will cherry pick a few. How many people here think you can have a net futures position? Who believes that you can have a purely long futures position without a short position linked to it directly? If you agree with it, maybe just nod your head or put a hand up or just, whatever, just indicate response. So everybody here knows that there is no such thing as a net futures position. Every single lot in every market that is a long position has a countervailing opposite short position. I'm amazed how often I come across the fact that people don't know this. How many people believe that the near $150 crude price in 2008 was driven by speculators' positions primarily, especially index funds, not by fundamentals? Anyone have any sympathy for that? A speculative flurry. Leo, you've got to. You're on record already. Oh, that's the most famous example that people tend to quote. Does anyone else have any sympathy with that view? No? So everyone else firmly believes it's all about the fundamentals. That's interesting. Okay. Modern oil futures markets are dominated by financial players. No? Okay. I'm going to assume that someone has sympathy with this, but you're not saying. It's the duty of regulators and policymakers to prevent oil price shocks. In other words, to prevent the price mechanism telling us what's going on. No? So I'm not getting a lot of feedback here, which is usually we get some, at least we get a bit of response, but I'll carry on nevertheless. Now, Charles touched upon the key issue of quality of crudes. It's absolutely critical to understand that crude oil is not a homogeneous entity. It has a bewildering array of qualities, prices, and densities, sulfur. We could name hundreds of parameters. I'm sure Charles probably has thousands. There are more than 500 crude oils identified. This is an array of a few of the more important ones. You can group them in many different ways. We've chosen to do this around a couple of our major benchmarks. You might say you would do that, wouldn't you? The green triangle there is Brent. The red triangle is Dubai. Many of these other grades are very familiar to analysts or to refiners. There are also a clutch of prices you can see out there to the left. If I tried to put in an Eagleford price, I think it is. You may not find that on there. I'm trying to think which one we've got here. We've got, we have Bakken, I think, on here, right at the edge. And this is purely density against price. So it's a very rough approximation for the value of the crude. They're an imperfect one. Eagleford is so far over that it wouldn't even show on here. And what that's telling you is that US crude prices are discounted relative to their theoretical quality. And you might say, well, is that to do with the fact they're not reflecting fundamentals? I personally would say, no, that's not the issue. They're the fundamentals of where they come from, the fundamentals of the supply infrastructure that they're trying to deal with. And Charles did a very good job of describing this 180-degree shift that has taken place as the US tries to orient from oil that is being found in the mid to north of the country that needs to get to the south. In the old days, it all came into the south, it went up. This is a gross simplification, but it basically went the other way around. And what the US is doing is in the middle of a period of adjustment to that. And that is at least part and parcel responsible for some of the differentials that we've seen. And I think the LLS issue is also one that was touched upon very well. The debate tends to focus a lot around WTI Brent. It's more complicated than that. And the shifts between Brent, between the US benchmarks and other global ones are multivarious. It's the whole of the complex that's reacting, reference the transport in the US, and particularly the products that get made. And I'll come on to a bit more of this later on. So what are benchmarks for? What do we use them for? Why are we even discussing them? Now, a lot of the discussion tends to focus on the outright, the flat price of crude oil. Is crude oil $108, whatever we define as crude oil? I can tell you now that 90, 95, 98% of traders don't care what the flat price of crude oil is. Most of the refiners don't really. What they care about is the margin between products and crude, the margin between different crudes, the margin between different products. Oil is overwhelmingly traded on a referential or spread basis. It's very important to realize that. Analysts, commentators, policymakers, very focused on the flat price of oil. Almost nobody trades the flat price other than the big futures markets. Most of the trading is actually on a spread basis to that. Most trading is not for a flat price in any way. It's a forward price, it's a spread price. I'm going to gloss over some of these a little bit because they're less relevant. But this referential issue is critical. We talk about Brent Dubai spreads, we talk about TI Brent, we talk about LLS to WTI. All of these issues are what traders actually trade. We particularly trade products to crude. Refiners are very focused on what we call crack spreads, which are a subset of the refining margin. They are driven by refining margins. And I'll get onto some examples of these in a little bit. So this referential issue is critical for understanding where prices come from. And we use this graphic I'm putting up here. It's a very crude, no pun intended, representation of how markets price. But the important thing to realize is product prices are not driven by the price of crude. Who uses crude oil? It's refiners. Refiners will not buy crude oil ad infinitum if they cannot make money out of the products. If product demand collapses, then you begin to get crude stems are not bought, the crude begins to accumulate, it prices at the margin, spreads go down, the outright price goes down. That is how this works. Crude oil is not discovered in a vacuum. Refiners pay irrespective and just take hits to their capital, hits to their stock prices. So this flows up, not down. Really, really important point. So many times I hear about discussions about crude oil as if it's just about OPEC. Those things are all of the upstream issues. It's the downstream that drives the upstream price. If the refiners don't make money on the margins, they stop buying crude. Simple as that in time. And that's what drives the issue with all of the Bakken prices, of course, in terms of what those crudes or condensates produce in yield terms, and which, of course, is also driving the US export discussion. Now, I don't want to get into a lot of ICE, TI, Brent, CME type things. Brent is the most important global benchmark. It's almost no one contests that. 7 barrels of physical are priced for Brent for every one that's TI. So this is the crude of choice, the crude that people trust all over the planet. 5 continents, not just producers because of the price, end users, traders, pretty much everybody. These are some of the other grades that price reference Brent. Five continents, and you'll hear different numbers, 65%, 70%. Platts say 70%. Other people say slightly less. Most people reckon that this is the one that is the most used benchmark. Now, I think Bob referred to the relative number of parts of Brent. This, again, is a classic referential structure, and I won't spend a lot of time on this. I want to get to some later conclusions. But the point is, this is a benchmark composed of lots of moving parts. That enables people to trade lots of different elements, some of which are purely physical, some of which are financial. That gives people the ability to hedge different parts of this in time and different elements of it. And the composite nature of that means that the arbitrage functions flow all the way around this benchmark to ensure that each of those price arbitrages are very efficient in delivering an accurate price discovery. Now, in terms of convergence between physical and futures, we often come back to this chart. This is what we call the EFP. It's an instrument that literally prices the convergence mechanism for Brent between physical Brent as it directly relates to the future, the forward cargoes, and the future. You can see what a small proportion of that difference is. That tends to reflect a small part of the forward timing curve. That's a picture of a benchmark that is working. Now, in terms of change, I think this has been admirably summarized already, so I don't intend to spend a lot of time. I want to pick out a few particular highlights. There's a massive production surge going on in the United States. It's something approaching 2 million barrels a day. The US has switched from being the global importer of choice. Something like a quarter of the global supply used to head straight to the States. The States was where the supply and demand cleared. That, of course, has changed. The US has now become a much bigger producer. US demand has flatlined, fallen slightly. The demand is coming increasingly from the east. So the demand supply picture has somewhat changed in the last 3, 4, 5 years, and the shale revolution is part of that. And the differentials you can see reflected largely by geographical arbitrage within the United States. Cushing has been described variously as a bottleneck and so on. Now, what's happened, of course, is that rail has become the default mechanism for getting the new grades to the coast, which is where they can clear against imported grades. But those new grades, even if they get exported, have some interesting quality differentials with conventional Brent-type light sweets. And I'll touch on those a little bit, although we're constrained on time. So I think, I can cut through these. I want to show, there was one chart, actually, I was delighted to hear the discussion of LLS. I'm going to put Dubai in as well, because this isn't about just Brent and TI. This is about a collection of crudes that price in reference to each other. In the old days, TI and Brent priced together because TI was the arbitrage achievable price that Brent was moving out of the North Sea to basically to come to the States to produce gasoline. You have to realize that not only is there a geographical difference, these two crudes make very different yields in different places. They could make different ones more similar to each other were they located there. Europe wants to produce a lot of diesel. The US is overwhelmingly a gasoline barrel. It's about 50-55% gasoline. The US wants to produce gasoline. That's what every refiner is designed to do. And they'll do this with cokers, with the crackers that Charles touched upon. Brent is about diesel. It's a diesel barrel. And Europe is short diesel. Europe does not have the capacity to produce its own diesel to the level that it needs to buy it at. So the diesel is heading into Europe from all over. It's heading from the US Gulf. It's heading from the Mideast. It's heading from the Far East. Half of the product going through the Suez Canal is from a single refinery. It's coming into Europe to supply Europe. So these are referential prices, arbitrage markets, but you have to understand it's the products that drive the crude, it's the yields that drive the price. Okay? These differentials will explain some of that, because if TI is about gasoline and US gasoline demand is cratering, if ethanol is going into that grade, then that has an impact. If diesel is short, if you suddenly remove 1 million barrels a day of conventional light sweet Libyan, that has an impact particularly on Brent, which is the local traditional light sweet grade. That has an impact on price disproportionate to TI. TI does not leave the United States. You won't see barrels of TI being exported to Europe, not to the Mideast, not to China, not to South Korea, not to India. It stays in the States. It doesn't move. It never did, even if you'd taken the ban away. That's going to the States to produce gasoline. Now, again, I think Charles has covered most of this. The main part that's relevant here is the change in the stocks between pad 2 and 3. That is another microcosm, really, of the rebalancing of the US, and, if you like, the collective bottlenecking of the US until there are changes in the overall status of the ability to export. Now, of course, the US is exporting a ton of oil. It's not doing it as crude oil. Crude oil traditionally is, if you like, it's the low margin way to do it. You export crude if you cannot export products. Refiners would much rather export products because that way they make more money, and the money effectively would stay in the US. You export the crude, someone else is going to turn it into very valuable clean products. Now, this graphic really shows some of the huge changes in flows that are going on. The particular reduction of light sweets into the US Gulf, which has been replaced by all the new shale, and the fact that West African grades are coming into Europe to replace, to some extent, just some of the supply that's going to Asia. So Asia is sucking in more and more crude oil in a way that the States used to do. And the big demand growth now is out of Asia. The production growth is in the United States overwhelmingly. And to some extent, that's been balanced up by OPEC. Now, I don't want to dwell too much on Dubai or gas oil. Gas oil, as I said, is effectively the product equivalent of Brent in global terms, and again is key in referential terms. Middle distillates is what drives the European crude price, not just diesel, but heating oil and also jet. Now, in terms of who's in these markets, there's sometimes a lot of discussion around financials, and I wanted to make a clear point about how balanced. I mean, I'm going to talk about the ICE contracts particularly, but you'll find this in other markets too. They are a healthy market like this, I would say, shouldn't be just all financials. You don't want financials just trading with each other. You want a mix of strategies in the people who are involved, different time frames, different desires, different price drivers for them. And I'm very happy to be able to show you a picture from our own commitment of traders reports to show just how much physical size is in here. And in a sense, the health of the mix of players. Around about 50% of Brent, for example, is what we call producer merchant processors, in other words, the physical players. And in gas oil, the proportion is north of 70% across shorts and longs. And I think that's good. And it's to reiterate the fact that these are not markets which are all composed of purely financial traders. Financial traders bring in a lot of critical liquidity. If you're trying to hedge short, you don't want to be just trying to deal with other hedgers. You want some long people who are prepared to take other positions as well. So if you look at this, I think you'll see a picture of a balanced and varied group of players. Now, these other charts here are really designed to reinforce the fundamental drivers of price. And we put the particular chart there on the bottom left is about the diesel crack. So this emphasizes that the 2008 price was on the back of a near $50 a barrel margin for diesel. And for refiners trading the spreads, $150 oil can be cheap and $10 barrel oil can be expensive. Because if they can't make any money out of the 10, they don't want to buy it. If every barrel they buy at $150, they can make $50 on diesel, of course they're going to buy it until that position changes. Now, as we know, China was stockpiling diesel very hard in advance of the Olympics in 2008. There are other factors going on at that time. The product margins were relatively strong. It's the refiners who are buying the crude oil overwhelmingly. If they can make money, they will buy crude at what looks like expensive outright prices. And the chart here on the right is the long-term refining margin. You can see from that you have what some people even called at the time, ironically, a golden age for refiners, with a positive margins for the first time some of them had seen in decades in the 2003 onwards period. That was able to support what looked like a rapid increase in outrights. And the chart here on the top left is about the net 40 largest positions that we have in Brent over a long period. They're net short. Big surprise. The commercials are short. And this is why I said the point about the fact you cannot have a net short or long position. There is always an exact same size long. Now, they may be held by different parts of the market, but you cannot have a long future without someone having sold it to you. So by definition, the interests in the market are balanced. Now, one of the other points about the debate that's sometimes missed is the interagency report on speculation in 2008. And we've had some discussion of our squareds and so on. I can tell you that we actually ran the chart here of the index positions in crude against the size of the against the price, and it's a near perfect inverse correlation. So if I was being cheeky, I might say, well, you want to make the price of crude oil go down, you better have some more index positions then. No, I wouldn't suggest that. That would be fatuous and not appropriate. But at the very least, you can say that there's no support for the contention that index positions drove the price up on the basis of what we see there. And that was said very clearly in the report. Now, there are some additional stats here. Some of these next couple of slides relate directly to tomorrow morning's topic, in fact, where we're trying to, I think, commingle the price changes and correlation in food and energy. And I just wanted to show you these. Some of these are from various bank analysts, so there's a lot of private research out here on these areas. You can see, looking at these, that these are all commodities. And over a price, this is this year, and this is a report from a couple of weeks ago. You have some commodities that are up 80% or 30%, and some that have fallen by 10%. Ironically, you'll find energy at both extremes there. And you can see the groupings there within the, that's actually the Credit Suisse index. You can see from that a pretty poor correlation in that between energy and agricultures. That doesn't suggest a very strong collective drive in price between both parts. And one of the best long-term pieces of forecast of analysis on commodity prices, admittedly it's focused a little bit on indexes, is the original paper, if you like, around commodity indices, the Gorton and Rowenhurst one. And there are a couple of iterations of that. But they ran correlations between ags individually and collectively and energy and all the other parts of a commodity index. And what they came up with is that they're very poorly correlated, which is why you put an index basket together, because you're looking for diversification. Diversification means that when one part of this is going down, another part's going up. And you don't want a +1 positive correlation across everything. That's what we had in 2008. So if you were trying to construct an asset instrument, you don't want everything to behave the same. And in fact, why they would want to have an index with lots of different types of commodities in it. And this, again, is a very similar representation of that kind of correlation, if you like. And you can see from here, the yellow line at the top there is unleaded gasoline, which has been a strong performer. And at the very bottom is nat gas, both energy. So not a lot of correlation there, even between two parts of the energy complex. And you'll find various ags in the middle. So I just put that up there as an instant and right up-to-date price history of parts of the commodity forum. It's also important to realize, although we're seeing prices at the moment around $110, $112, there actually has been a fall in the total amount of money dedicated to commodities. Whether you think that's good or bad, it's a fact. And just one last point, and this is not to belittle these points. Occasionally people, when they manage to discover correlation, there can be a sense where people may begin to believe there is a causation factor behind that. And I sometimes come across papers in academia where this is without any real explanation of exactly what the causative factors are or a model for how they might have led to the other. Now, you can do clever things like Granger causality tests, which the CFTC certainly employed. But this is just a cautionary view as someone who's spent nearly 30 years in markets to not assume, because you think you found a relationship, there's one drives the other. And this, again, not intended to be fatuous, but just a reminder to try and establish that one does genuinely drive the other. I put this one up, which is a classic example of a market which had the ultimate position limit. They basically banned the future. And obviously this was the point immediately up to the announcement of the ban against onion futures markets. They were very concerned at this point about the amount of volatility in the market. And the feeling was that if futures were banned, obviously that would reduce the volatility of the physical price. And this is what happened. So obviously you see that had a very useful effect. Not only could they no longer hedge, but they were actually having higher volatility. And what analysis I've seen would suggest that overall futures markets marginally lower the net amount of volatility in the underlying. Not only do they do that, of course, they actually enable you to hedge against it, which is actually quite a useful function. So I will just cut through to my conclusions as I'm running out of time, and I'm sure everyone has probably put their time in today. I think really it's really just, this is intended as a little bit of a cautionary tale around some of the ultimate areas of policy discussion that have emerged. Just, I think, particularly to remind folks in Europe that we're actually in a relatively good position considering we are We don't have complete security of supply, but we have two very important energy benchmarks here. And we hope that those are not damaged by changes that mean that price discovery goes somewhere else. And I'm sure that Bob will confirm that the US would be delighted to have the number one futures back. But sorry, Bob. The other critical point is that liquidity is the ultimate guarantor of efficient price discovery as well as cheap execution. Everyone takes liquidity for granted. It's the hardest thing to build. It's the easiest thing to destroy. It's fairly sticky. You destroy it, then you will have consequences in terms of the executability. You only have to look at what happened to interest rate markets and credit markets in 2008 to realize when you get a huge market failure. Look at the California electricity markets when people decide that they want to change the structure. Suddenly, you get no more supply. The danger of having a price target built into policy making is that the energy markets might just decide they don't want to supply at that price, or they cannot supply at that price, and suddenly you've got a very desirable price but no energy. And if you think anything focuses the ultimate voter faster than the lights going out, you probably don't remember the early 70s. I certainly do at home, but it gets people's attention even faster than the price of gasoline going through $2 in Texas, or wherever it is now. It's probably more like $3.50, but it's $3.50 in the cheap places. But I remember I was there one time when it went through $1, and that caused a huge outcry in Texas. Put it that way, which I think is about a sixth of the price in Italy. So I'll cut to the chase. That's everything I intend to say. I'm going to be around tomorrow if you have any particular questions around any of this. The slides will be available. There's way more than I was able to talk about today. And as I hope you've sensed, I can talk about this all day without any trouble at all. Lastly, should add that I wanted to thank Laura very much for putting this all together and for fitting me in at relatively short notice. So, thank you.
Thank you very much, Mike. We've got about 15 minutes for questions. Before we go into the question and answer session, may I remind the audience about the third session beginning tomorrow at 9:30. Okay, so Lutz?
Yes, I have a clarifying question for Charles. So you described how we had an influx of oil from Canadian oil sands, very heavy stuff. We had an influx of ultralight shale oil, all into Cushing, Oklahoma, and you attributed the fall in the WTI price to this glut. But WTI is, of course, the price of a very specific type of crude oil, which is somewhere in between the shale oil on the one extreme and the oil sands oil on the other. And so presumably there must have been a distinct reason why the price of WTI fell. Perhaps because of transportation bottlenecks or something like that. But it can't have been the influx of Canadian oil, for example, because that shouldn't have been counted in that price index. And so if you could clarify that, that would be good. Second question is, do you know anything about how substitutable, from a European refiner's point of view, Libyan oil and shale oil would be? So if the US were to export, could those refineries use shale oil, or is it too different? And a last question for Robert, or more a comment. So I saw some of your regressions having very high R squared and highly significant coefficients. I didn't see the specification, but it made me worry that this might be a regression levels on levels. And if that were the case, that might suggest a spurious regression problem, which you might be able to fix if that's what the problem is, by including a lag-dependent variable, for example.
I'll go first. Or not. Go ahead. While I try to figure out how to turn this.
No, just push it.
Oh, follow the instructions. Okay. I don't have a firm answer for either question, but that's never stopped me in the past. So I'm just going to go out on a limb here and say I think the benchmark price at WTI can be thought of as a convex combination of the heavier Canadian and the lighter tight oil, so that a rising tide raises all boats sort of effect, that they all ought to be correlated in a very particular kind of a way. I might have cut a few corners there, but I think generally what I said was correct. I don't have a good answer for the European refinery question. I honestly don't know much about European refineries, but I would guess that, again, there might be some way of constructing, my sense is that this is what American refineries try to do. They try to construct a composite by blending different kinds of crude oils. There are limits to that, but I would guess that that's the general idea.
I thought the typical blend would be a blend that mimics Venezuelan or Mexican crude oil, which would be heavier than WTI.
Mike can answer.
I can give you, I mean, I've spoken to refiners in Europe about that, and I think, as we know, the US has put in a certain amount of pre-splitters and other units to try and deal with the ultralight sweets and so on, and there's a certain amount of blending going on. But a lot of the blending solutions are not, people are not very happy about them long term, and it's fine. Obviously, the new stuff is producing a lot of gasoline components, which is mostly what the US wants. But in Europe, we already long gasoline. So in terms of exporting all this condensate type material to Europe, it's less valuable here. What Europe really wants is conventional light sweet that it can put through, you know, medium complexity refineries. In other words, it wants Libyan back. Well, Libyan's better than that, but it wants Libyan and Algerian and North Sea. It doesn't really want 50 API condensates. And Europe also is trying to scale down its refining, not put in capex. I'm sure Vince has got some observations on this, but
A very quick comment on condensates. You know, what is most likely to happen is that condensates from the US, if the ban is lifted, will go to Asia and will be used as a feedstock to chemical plants and refineries.
Of course, field condensates can already be exported. You don't need to go around the ban at all. It's only if they've been split through the FCC that they need because they're treated then as something different. But there's not really I think the definition of that is a little bit hazy. It's
more complicated. If I explain it in 30-45 seconds. You know, in the US has two different definitions of condensates. If condensate is produced at the wellhead, it's called least condensates, and it's treated statistically as part of the oil production and cannot be exported by the same mix of hydrocarbons if it's produced in the natural gas processing plant, and effectively the same as condensates. It's called natural gasoline, C5 plus or pentanes plus, and it's effectively the same as condensates, but it's treated differently and can be exported.
Yeah, that's true. Europe is not exactly desperate for that type of product, to put it mildly. Europe's trying to scale down its refining commitment to that. Rather than, you look at what's going on in the discussions in France or wherever. People don't want more refining. They don't want to put the capex in. They want to remove it and put it somewhere where it can generate more clean products, more diesel and other products. Not to produce gasoline here, which we're already exporting in as fast as we can.
There's a question down there. Did someone raise their hand? Bassam?
Yeah, I've raised my hand, but Mike answered
Okay.
the questions.
That's a good one. We 2 in 1. Anyone else?
Well, on the, and I'm not actually sure, well, first I'd like to chime in on the last topic. I'm a little less dubious that exporters of oil in the U.S., if permitted, will have difficulty finding a market. Of course, Charles, you can check it out. It sounded as though you actually knew the person that filed for that export license. Whether you did or didn't, you may be able to find out, unless the operating assumption here is that they're filing for a license and they have no clue where they're going to sell it, which I don't think works when you have one of those licenses, because I think you have to say where you're going to take it. Secondly, I don't doubt that people don't want lease, or condensate if you prefer. EIA actually released something this week which was sort of interesting, because it gives a lot of details. Now maybe people disagree on it, but then they should disagree with the EIA, because it talks about really how much production is coming from all these new places in the U.S. It's talking about what the API is, and it's also projecting through 2015 what those API levels will be. Now there will be some lighter stuff, but and the reason I looked at it, I thought it might be useful to bring, and I just saw it a couple days ago. It just happened to be, they released it, but when you showed in your first slide, Charles, on Eagle Ford, and you just jumped to 55 degree sort of condensate. I wasn't sure why you focused, maybe just illustrate the point, boy, this is really light, but that's not what they think's really being produced. Now, that's not that they say none's being produced, but they talk about above 50, and actually above 50 is going to be less through 2015. I have no idea what they're thinking beyond that, because it only goes through 215. In fact, this is Eagle Ford right there. You can see that's above, that color, whatever you want to call that, is above 2000, above 50. The 45 to 50 seems going to constantly grow a little from today, or well, about the same, and the 40 to 45. So there's no question there's lighter stuff, and people can sit there and debate whether, but it isn't all condensate. And I was actually surprised that the highest stuff was decreasing, because I thought that might be increasing myself, just from talking with some people, but it was all anecdote. So that, for EI to come out with this, it was actually very timely, but I don't think anybody is seeking, there are people seeking licenses for that crude oil, okay? You can make the judgment if you think they're wasting their time, that they have no market. I think that's, I don't think that's a very sensible assumption to make. And if somebody says, gee, it's not exactly like Libyan, so I'm not gonna use it, okay, well, somebody will buy it, and somebody will make product and compete with that other party. I mean, they've got to be, if you're saying that they have no flexibility in Europe, I mean, European refineries, it seems to me, I mean, right now the U.S. is providing more and more refined products to Europe, and it may continue to do that. It's one way or the other, but I doubt that the reason for that is because Europeans are utterly stubborn and said, well, if it ain't this, I'm not using it. It may be that if with they have some flexibility, but we'll see. I mean, that's not, I guess we're not really the ones that decided. Well, it's a fair question. I can tell you that others have done it and had high R-squareds on those. I don't think that that's, and I think that, I mean, Craig Perrong did it, and he certainly is more capable than I, and he went into levels of it that his own, I mean, perhaps you even would have professional criticisms of that, but they'd be at a level that you'd at least have to acknowledge he would be able to at least adjust for the problem you mentioned. I can certainly go back and look. I think that it's been, I mean, it should be, I mean, we're just talking about the contango. I mean, shouldn't the contango or the backwardation between the first and second month, it shouldn't be that surprising that it's very responsive to important factors. So I mean, if it isn't, then and one way or the other, and there's certainly, I would certainly accept that depending on what the differential, the forward curve is between those first 2 months, would also have an effect on how much people would stock and where they'd send oil. I mean, I don't think so. I mean, I think I mean, it just seems the economics of it should make sense, and whether there's some reverse causality in there, I don't know that I'd want to at least.
It's not about reverse causality. Even if you had two completely independent time series, for the sake of argument, not that I think that's what's going on.
Yeah.
But if you had, you would see exactly the same pattern of highly significant T statistics, high R-squares by construction. And so all I'm saying is that in that case, you can't infer from that regression that your intuition about what's going on was right. All you need to do is add a lag-dependent variable and then see what happens with these coefficients, and that will tell you.
I mean, that's fair. I will also say that even though it probably wasn't for that purpose, I happened to use the Friday prices for the for Brent and for WTI. Actually, the information is as of Friday. Now, there's two ways to do it. I mean, but that EIA collects. It's as of that Friday, but they don't release it publicly until the following Wednesday. Now, so I may have perhaps created my lag sort of unintentionally in there. Now, that's a weak lag in there, but that would be, at least that would address that. And even Genscape, which does give its projections or its assessments, which I think tend to be pretty accurate, of where inventories are. If you know Genscape, they're a firm in the U.S. that provides sonar and other sort of flyovers of the storage facilities and then gives that information out to people in the market, but they give it out after that Friday. I mean, they don't do it as of the Friday, that's for sure. So I can't have the overlap. But I mean, it's certainly something worth considering, but I may have inadvertently put that lag in there, stumbled onto it. You know, as somebody once said, it's better to be lucky than smart.
Yes, maybe you should continue this discussion later. Well, thank you, ladies and gentlemen. We've arrived at the end of the session. It's 6:45. I think everyone must be pretty tired by now. And I hope you have a good evening, and see you tomorrow at 9:30. Thank you.